Have you ever found yourself pondering how traders spot market trends and make smart decisions? It all kicks off with one fundamental concept: understanding trends. A trend can be defined as the general direction the price of a security or the market takes over a specific period. There are three main types of trends that traders identify: uptrends, downtrends, and sideways or range-bound trends. During an uptrend, the price of a security progressively reaches higher highs and higher lows over time. On the other hand, a downtrend sees the price making lower lows and lower highs consistently. Lastly, in a sideways trend, the price maneuvers within a horizontal range, avoiding any significant higher highs or lower lows. And that, dear viewers, is how our traders make sense of the market's ebb and flow. So you might be wondering, how do traders actually identify these trends? Well, they employ a number of techniques to do so. One such method revolves around visual inspection, and it's as simple as glancing at price charts. Traders look for patterns in the ebb and flow of prices, higher highs and higher lows when it comes to an uptrend, or lower lows and lower highs for a downtrend. Another technique involves the use of moving averages. This method smooths out price data over a predefined duration, making it much simpler to pinpoint trends. For this, traders might lean on simple moving averages or even exponential moving averages. Trendlines are yet another instrument in a trader's toolbox for identifying trends. These lines, sketched on a price chart, connect consecutive lows in an uptrend or consecutive highs in a downtrend. They don't just help in visualizing the direction of the trend, but also act as markers for potential support or resistance levels. And then, we have technical indicators such as the relative strength index, moving average convergence divergence, and the average directional index. Traders use these powerful tools to not only identify trends but to also gauge their strength. In conclusion, traders employ a variety of tools and indicators, including the relative strength index, moving average convergence divergence, and the average index, to identify trends and their strength, giving them an edge in the fast-paced world of trading. Identifying trends isn't just a one-time frame game. It's of utmost importance to scrutinize trends across varied time frames to acquire a comprehensive view. The usage of shorter time frames is ideal for making short-term trading decisions. On the other hand, traders resort to longer time frames when conducting a more extended trend analysis. To sum up, traders frequently employ shorter time frames for quick trading choices, while utilizing longer time frames for an in-depth trend analysis. Once a trend is identified, traders often lean towards trading in the direction of the trend, as it typically augments the chances of success. One such strategy is trend following, which entails traders engaging in buying securities when there is an uptrend and short in a downtrend, the objective being to benefit from the continuation of the trend. Another lucrative strategy is pullback trading. In this scenario, traders look for temporary retractions within the larger trend to enter trades at prices that are more favorable and beneficial. Finally, let's delve into breakout trading. This method involves the identification of instances where the price breaks out of a consolidation or trading range, indicating a potential continuation of the trend. This strategy could be a game changer, as it provides traders with insights into market trends and, in conclusion, breakout trading, where traders keep an eye out for instances where the price exits from a consolidation or trading range, can serve as a signal for a potential continuation of the trend. This is an important strategy for any trader to master, as it can create valuable opportunities for profit. While trading with the trend can potentially lead to profits, it's paramount to manage risk effectively. Effective risk management is the backbone of successful trading, ensuring that potential losses are contained and don't spiral out of control. One indispensable technique to manage risk is the use of stop-loss orders. These orders act as a safety net, limiting potential losses by automatically closing a trade if the market moves against you to a certain extent. Moreover, position sizing techniques are crucial to control risk exposure. By carefully deciding on the amount of money risked on each trade, traders can better manage their risk. Wrapping up, it's not only about identifying trends, it's equally crucial to employ a variety of methods for trend analysis. Furthermore, integrating risk management strategies into trading plans is a must for any trader. This multifaceted approach can boost chances for success in the ever-volatile markets.